Let's bring in our all-star housing panel. Jordan Shea, real estate salesperson over at Douglas Elliman Real Estate, joining us right here on set. And Daryl Fairweather, chief economist at Redfin, joining us remotely from Seattle, Washington. Thank you to you both. Daryl, let's begin with you. How are you feeling about the real estate market overall? We just got in a mixed bag when it came to existing home sales and new home sales.
Mortgage rates are down, and that's good news for buyers because it means that they can afford more and their mortgage payment won't go up by as much. But mortgage rates aren't down in a vacuum. There's global recession risk right now. People are aware of that, and buyers may not be as willing to make a big purchase amidst all that risk. But the first order effect, the primary effect, is that mortgage rates are down, and that's overall good for demand.
Jordan, what are you seeing? I mean, you're right here in New York City. I don't know if that's your home base for what you sell at Douglas Elliman, but what are you seeing?
I'm seeing across the board, there's obviously a slippage in sales in terms of overall activity. Absorption rate is up, which is a metric we use of how long it takes for a particular product to move or an apartment. That's up across the board. Median sales prices, they rose, but on a price per square foot basis, they've been relatively stagnant. At one point, I want to say 7% Q2 2019 as opposed to Q2 2018, which means it's actually sort of a loss against inflation. It's just soft right now.
So a little bit soft. Daryl, what do you make of it, and when do you think we might see a turnaround? I mean, first of all, mortgage rates are as cheap as dirt at this point. People have been refinancing and refinancing. You have a pretty strong economy. People have jobs. They've had some wage growth. But the question sometimes is supply, right? Whether or not there's supply in housing and whether or not people are willing to take the bite into housing. Why did we have a little bit of a miss in new home sales today?
Supply has been a problem for a while, and that has decreased affordability for a lot of people. A lot of people are looking at that sticker price. They don't have enough for a down payment, and they don't see home buying as being affordable right now. That problem had been bubbling up for the last couple of years, and it came to a head in the last half of 2018, and people are still grappling with that, even with low mortgage rates. We may not see low mortgage rates have a huge effect on the housing market quite yet because we're already so late into the housing season. People are worried about starting their kids in school, and they may not want to disrupt their lives right now. So if a recession doesn't happen, I think 2020 is going to be a much more competitive year.
I was looking at some of the movers, right? D.R. Horton, Pulte Home, KB Home. They've had great years. Meritage has been a great performer this year. And Seaport Global actually has buy ratings on the first three that I mentioned and has upside potential price targets. Jordan, where are you seeing, if you break it down, I don't know if it's into smaller segments, you could even break it down within the city. There must be pockets of strength versus pockets of weakness. Where is that?
I mean, the weakest price category for us typically, and it's across the board, is the super luxury. But now we're seeing that sort of trend down to where we're getting weak in the 4 million plus price category, 3 million plus price category. Our safest bets now are 2 million and under, and really I'm seeing 1.5 million and under moving much quicker across the board. It's true, though, that it just has to be priced right. Something that's priced right and, frankly, ahead of the curve is always the way to go. Right now, we're seeing decreasing prices. I actually believe that if you want to get ahead of the trend, you should price slightly below actual market value now so that you beat the market. You'd rather get into a bidding war situation where people are emotional as opposed to one where it just sits and then the product becomes stale.
Right, and you made that point that some of the homes are sitting for longer periods of time. Daryl, what about the breakdown, single family homes doing a little better, millennials and their interest? Is there any sort of breakdown within housing that caught your eye?
So we're also seeing that affordable homes are the ones that are going to be guaranteed to sell and are seeing the most price growth. The bottom third of the market in terms of price, that is growing at 9% year over year. The top third only growing at 1% year over year in terms of price. So it really is those affordable homes. And that's true if you're looking across the country, more affordable places, those markets are doing well. Or if you're looking within a market, like if you're in Seattle, the most affordable homes are going to be quicker to sell than the least affordable homes.
Daryl, what about mall-based retailers, all of these things. They're trying to fill all those spots. I mean, we know some of the retailers are struggling within the malls. What about mall properties?
If you're talking about people wanting to live near a mall, I don't think that's something appealing for millennials right now. I think they'd rather be in the city center and be close to their jobs.
Okay. Right. Jordan, what about you? I mean, I'm thinking more corporate, I mean, as opposed to residential. Any thoughts on the corporate side of this?
Well, the closest comparison we have to a mall right now in the city, I would say, is probably Hudson Yards, which has a high rate of like ultra luxe retailers. It has an experiential component in the art project there. A lot of retail space, commercial space. We have a lot of offices there and residences. And so it's doing reasonably well, but still there's a saturation point with the number of people who can afford to live in those types of units and really have an interest living in that particular location, which is sort of a vanguard, far west, almost an artificial neighborhood.
Yeah, I don't go that far west. It feels so far from my home that's on the east. When you live on the east side, you don't really go west. When you live uptown, you don't go downtown. Everybody likes to stay pretty much where they are. Last thought, Daryl, you know, the SALT tax, I think, sort of crushed some, the luxury moved really fast. They tried to sell some of that out, and now it's a little bit stale, right?
Well, we're seeing that California, all the West Coast markets are doing pretty weak right now. And if you're in California, you're getting hit with high state income taxes. You can't deduct as much of them anymore. Plus, the mortgage interest rate deduction is lower than it used to be. So you're just kind of getting hit on all sides. And we think that's part of the weakness in California.
All right. Jordan, is Chelsea still the hottest in New York City?
I'm not sure it was really ever the hottest in New York City.
That's what I heard.
I mean, it's what you hear.
What's the hottest?
There's the High Line blip. I just think I don't believe in the hottest neighborhood, to be honest. It's never a really good investment because it'll be the not hot neighborhood the next time a good one comes around. I think the West Village is always a good buy.
All right.
I think anywhere Greenwich is fine, and Upper East Side is a value play.
Okay, and some good schools.
Great.
All right, thank you, everybody. I hope you have a beautiful weekend. Jordan, Shea, and also Daryl Fairweather, thank you both. Thanks for watching The Watch List. I'll see you on Monday, folks.